Part 1, Revenue Recognition, and we're going to look at single and multiple performance obligations. Now, under the new revenue recognition policy, core principle is that companies should recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for those goods and services. When, upon transfer to customers, how much amount the seller is entitled to receive. Now, the reason that revenue recognition has become so complicated is because of the internet and because of people, when they buy something, it's not the end of the service. They may end up buying a computer and getting 2 years free service. That is an extended warranty outside the normal warranty. Or they might get a coupon viable for 50% off of one of the other products. Under the new revenue recognition policy, we need to take this into account when we book the revenue. Now, there is a 5-step process, and I think it's really 5 things you need to always look at when you're deciding when to recognize the revenue. First of all, you have to identify the contract. What is the legal rights of the seller and the customer have established? What have they agreed to? What are the performance obligations? A performance obligation is a promise to transfer a good or service that is distinct, which is the case if the good or service is both capable of being distinct and separately identifiable. Now, we have single and multiple performance obligations. Now, here's something to remember. A right of return is not a performance obligation, but instead a variable consideration that will reduce the revenue at the point of sale. A variable consideration is that based on something happening in the future, the revenue stream may change. i.e., if someone buys a service contract and they're told if you meet a certain goal, you're going to get a 20% bonus. If you don't meet the goal, you're going to lose 20%. And that would be considered variable consideration, and that must be taken into consideration at the point of sale. And we'll go through some examples like that. Now, step 3, we need to determine the transaction price, the amount the seller is entitled to receive from the customer. We have to then allocate the transaction price. If there is a single performance obligation, no allocation is required except if there is variable consideration, which again is a potential change in the revenue amount. Then there will be an allocation. And multiple performance obligations. Allocate a portion to each performance obligation. This is always done based on fair market value. Now, a PO is a performance obligation, just so you know that. And then our last step is recognize the revenue when or as each performance obligation is satisfied. Again, we can have single, which is at a point in time or over a period of time, and we can have multiple at whatever time is appropriate for each performance obligation. Now we're going to look at a couple examples. Now, in this example, Mike sold 10 vacuum cleaners for $500 that include a 1-year warranty that covers any product defect. When customers buy the vacuum cleaner, they have the option of buying an extended 3-year warranty that covers breakage and maintenance. The extended warranty sells at the same price regardless of when purchased for $75. How many performance obligations are there, and what is the journal if purchased on account? Now, we'll go through our 5-step process. First, identify the contract, which is to provide 10 vacuum cleaners. Identify the performance obligation. There is one performance obligation, provide 10 vacuums. The 1-year warranty that is included as part of the purchase is not a performance obligation, but rather is part of the obligation to deliver a vacuum of appropriate quality. And what we do here is we would set up a warranty reserve. That's how we would offset that. Determine the transaction price. The transaction price of 10 vacuums times the amount equals $5,000 were recorded when ownership has transferred. Now there's only one performance obligation, so it's the whole $5,000. And we will recognize it upon delivery or when goods transfer. So, what does it look like for a journal? Accounts receivable, since they were on account, 10 times 500 vacuums. Remember when you're doing your homework to take into consideration how many units are sold. The sales revenue. So that would be how we would handle this particular problem, which is the way it used to be. This is how you would record a sale. Now we're going to look at recognizing revenue over a period of time if any of the following 3 criteria are met. The customer consumes the benefit of the seller's work as it is performed. Example would be a cleaning service. The customer controls the asset as it is created, constructing a building. The seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress to date. Revenue is recognized in proportion to the amount of performance obligation that has been satisfied. So now we're going to look at an example. Now, Company A signs a contract to provide equipment, including installation and a 2-year service agreement at no extra charge. The equipment sells for $1 million with or without the installation and service agreement. Payment is due 1 month after installation. The installation has a fair market value of $60,000 and the service contract has a value of $40,000 if sold separately. The cost of the equipment is $550,000. The equipment is delivered on June 1st and installation is completed on August 1st. Payment is received on September 1st. What are our journal entries? So, what information do we need? Well, we know they have to provide equipment, installation, and a service agreement. We know that it sells for $1 million, and we know the fair market value of 2 of the items, which is the installation and the service contract. We also know that our cost of goods sold is $550,000. Now we know what to do. Now we're going to go again through our 5-step process. So, first, identify the contract with the customer. What we're going to do here is we've signed a contract to provide a future date equipment installation and 2 years of service. Identify the performance obligations. We have 3 performance obligations. We have to provide equipment, we have to install it, and we have to provide 2 years of service. Determine the transaction price. What we have to do is we have to take the $1 million and allocate it to the 3 performance obligations. How are we going to do that? We're going to use fair market value of the items that we have. And then we're going to recognize the revenue as each of the performance obligations are satisfied. So first what we're going to do is look at how do you allocate the selling price. So, determine the total fair market value and determine percentage of each based on the total fair market value. Okay, the equipment is worth $1 million. Now, you're always going to divide by the total fair market value. So what we have to do is go through this process first, and we know the total fair market value is $1,100,000. We then divide each of the elements by their by the total fair market value. So the equipment, $1 million is divided by $1,100,000. 100,000, which means it's 91% of the total. Then we get installation and service, and when we add those numbers up, remember they have to equal 100%. Now we're going to allocate the sales price based on the percentages. So for the equipment, we're going to take the million times 91%. We're going to do the installation and then the service. And when we add those up, we must get $1 million. Okay, so it must equal 100%, and the total sales price after you allocate has to equal $1 million. Now we can go ahead and do our journal entries. When the contract is signed, we do nothing. June 1st, we've delivery of the equipment. It's our first performance obligation. We're going to book our accounts receivable, and we're going to then book our unearned service revenue for our installation and service. Now, under the new revenue recognition rules, you record unearned revenue even though you did not get an advance payment because the contract sets up the liability. That's what's different between the way we used to record revenue. You used to only record unearned revenue when you got cash in advance of providing services. No more. Now, if we sign a contract and we have parts to fulfill, we're going to record that as unearned service revenue because it becomes a liability if we don't do it. And then we can record the sale because we have delivered the equipment. So ownership has transferred, and we can book the cost of goods sold. Next, on August 1st, our second performance obligation, we have installed the equipment, so we can book that revenue. Then we made a payment in full. We're going to take our accounts receivable off the books. And then December 31st, we're going to allocate the service revenue, which is our third performance obligation, which is over a 2-month period. So we're going to take 36,000 divided by 24 months times 5 months have gone by, and we're going to have earned $7,500 in revenue. That ends part 1 on revenue recognition.